The Credit Trap: How Debt Became a Product. In 1958, a bank in Fresno, California, mailed 60,000 people something they never asked for. No application, no credit check most could understand. Just a small plastic card and a letter that said, "Your money is already here." This is the story of how borrowing stopped being a last resort and became something sold to you like a lifestyle, and the man who engineered it never intended to build the thing he built. Before that morning in Fresno, credit worked on trust between neighbors. A shopkeeper knew your name, your job, your father. If you needed flour before payday, he wrote it in a ledger and waited. Debt was personal, it had a face attached to it. Banks were cautious institutions, wary of lending to strangers, and department stores issued their own private cards, good only within their walls. A bank executive named Joseph, working for the Bank of America, saw something nobody else did. What if a card wasn't tied to one store, but to every store? What if a bank, not a shopkeeper, decided who deserved trust and did it at a scale no shopkeeper ever could? The idea itself wasn't complicated. The execution was reckless. Joseph and his team selected Fresno as a testing ground, a mid-sized city where they could study behavior without national attention. Rather than asking people to apply, the banks simply mailed working credit cards unsolicited to 60,000 residents. Instant access to revolving credit. No waiting, no explanation required. The reasoning was simple and slightly terrifying. If people already have the card in their wallet, they won't wait for a reason to use it. It worked, almost immediately and almost catastrophically. Some cards ended up in the hands of children, pets, and people who had died. Fraud spread faster than the bank could track it. Criminals intercepted mail and drained accounts before homeowners even knew a card existed. Losses mounted into the millions. Internally, executives debated whether the entire program was a historic mistake. But underneath the chaos, something else was happening. The people who did use the card responsibly weren't just buying things. They were buying things they wouldn't have bought with cash in hand. A refrigerator that could wait now didn't have to. A vacation postponed for years suddenly wasn't. For the first time, a purchase and a payment could be separated by weeks, sometimes months. The bank had accidentally discovered a psychological lever more powerful than fraud or convenience. It removed the friction between wanting something and paying for it. This single shift is the foundation of behavioral economics around spending. When people pay in cash, the physical act of handing over money creates what researchers call the pain of paying, a small but real psychological resistance. Credit removes that resistance. You feel the pleasure of the purchase immediately. You feel the cost of it later, disconnected, abstract, and easy to underestimate. The bank hadn't just built a payment tool. It had built a time machine for spending, one that let the future subsidize the present. By the mid-1960s, the mailing mistake had been contained, but the lesson had not been forgotten. Other banks noticed what Bank of America had stumbled into and moved quickly to compete. A rival group of banks formed a shared card network, eventually growing into what the world would come to know as MasterCard. Bank of America's own card eventually became Visa. The unsolicited mailing method was outlawed by Congress in 1970, but the model survived. Only the delivery changed. Instead of mailing live cards, banks began mailing invitations, applications, offers, each one engineered to feel personal, urgent, and already approved. This is where the story stops being about a single bank and starts being about an entire industry learning the same lesson at once. Convenience sells, but psychology sells more. Card companies began studying which words on an envelope increased response rates. They studied which interest rate structures encouraged minimum payments rather than full ones. A minimum payment, small and manageable, felt responsible to the person making it. In reality, it was often the single most profitable behavior for the lender, stretching a purchase's true cost over years through compounding interest. Here, it helps to understand what compound interest actually does in this context. If a balance isn't paid in full, interest is charged not just on the original amount borrowed, but on previous unpaid interest as well. A television bought for $600, left on a minimum payment plan at a high interest rate, could quietly cost more than double that original price by the time it was finally paid off. The debt wasn't dangerous because people were reckless. It was dangerous because the true cost was almost invisible in the moment of spending. By the 1980s, credit had become fully normalized, taught not as a warning, but as a rite of passage. Companies set up tables on college campuses offering students their first card, often before they had any steady income at all. Executives at the time understood something uncomfortable. A habit formed early, especially one wrapped in the feeling of independence, tends to last a lifetime. This wasn't purely predatory in intention. Access to credit did give millions of Americans real opportunities, emergency flexibility, the ability to build a credit history, and purchasing power they didn't have before. The technology itself was neutral. What mattered was whether the person holding the card understood the mechanism behind it. And this is where the credit trap reveals itself most clearly. It isn't a trap of bad intentions. It's a trap of mismatched timelines. The reward is immediate. The cost is delayed. And human beings, across nearly every culture and every income level, are wired to weigh immediate rewards more heavily than delayed costs. Behavioral economists call this present bias. Marketers simply call it good business. By the 2000s, credit scoring had become its own quiet gatekeeper of American life, determining not just loan approvals, but apartment rentals, insurance premiums, and even certain job applications. A three-digit number, invisible to most people until the moment they needed it most, now shaped opportunities far beyond borrowing. Understanding that number changed the game for those who learned it early. A credit score responds primarily to a handful of factors: payment history, the percentage of available credit being used, the length of credit history, and the mix of credit types held. None of these factors reward debt for its own sake. They reward consistency and restraint, the exact opposite of the impulse the original mailed card model was designed to trigger. This is the quiet twist in the story. The same tool built to encourage effortless spending could also become one of the most powerful tools for building financial credibility, if used with discipline rather than convenience. Those who paid balances in full each month captured the benefits: purchase protection, fraud security, building a track record of reliability without ever paying the compounding cost of carried debt. Those who didn't often found themselves funding a system that was never designed with their long-term interest as the priority. Both used the exact same piece of plastic. The difference wasn't the card, it was the understanding of what the card actually was. Today, a purchase can be completed in less than a second, tapped, approved, forgotten. The distance between wanting and buying has shrunk to almost nothing, and the distance between buying and paying can now stretch for years. The mailed cards of Fresno in 1958 were reckless, chaotic, and by most measures, a mistake. But they revealed something that has never stopped being true. When cost and consumption are separated by time, most people will underestimate the true price of what they're buying. The banks that built this system didn't necessarily set out to trap anyone. They set out to remove friction. But friction, it turns out, was doing something useful all along. It was giving people a moment to think. The lesson isn't that credit is dangerous. It's that any tool which separates a decision from its consequence deserves a second look before it's used, not after. This video is for educational purposes only and should not be considered financial advice.